So I listened to like 20 minutes of it, and I think the most important point that he made was that he is aware of his effect on market expectations, which of course he is. But that's important because one of the things I've been saying, I think this is the third week now, is that the Fed is going to use its mouth well in advance of it actually using its tools. It always does, and in this instance, it's no different. And the market is moving, both bonds and stocks, toward where the Fed ultimately needs them to go if we're going to get inflation moderating. I say on its own, it's not really on its own, but you have to believe that a $38 trillion stock market is now extremely important to the wealth effect that drives a lot of what's going on with inflation. Not all, because of supply stuff, but on the demand side, stocks and home prices are the two big things. Home prices are now moderating, fourth month in a row that market is cooling off. And now the stock market started the year with the worst January pretty much ever. So these two things get the Fed closer to where it wants to be ultimately without the Fed even having moved the chess piece yet. So I think it's constructive. I liked hearing Powell point out that he is aware of that impact. And I think markets are being rational in light of the fact that we've probably been stimulating for 6 months longer than we should have been.
Mike, I'm interested in your take on what this extraordinary intraday volatility means. Clearly, earlier in the week, it was from lows to highs, the opposite today. But another sort of 900-point intraday move on the Dow. Is that sort of the sign that the bull market's going to continue, or is it hard to draw any firm conclusions?
Well, there's no way to declare it one way or the other in terms of, interpreting that type of day-to-day volatility or intraday volatility and say all of a sudden it's a totally different market regime. I don't think that's true at all. What it does show you, though, is we have broken the very, very sturdy and quiet uptrend that we had last year. That's been going on for the last few weeks. We also, though, for as wild as the moves seem today, it was 100% within the range of the last 5 trading days. So once you kind of break through and widen out the scales of what these daily moves are, all of a sudden there's kind of freedom to move within it because we just saw those prices a few days ago, right? So it suddenly doesn't seem as dramatic. But it also fundamentally tells you there's a fairly wide spread of possible paths, both in terms of macro direction and policy reactions, that the market now has to consider as we decelerate in the short term, but we think we're going to reaccelerate. And the Fed's reaction function seems a little bit more attuned to upside risks on inflation. And therefore, we might have a lot of play in what, in fact, the monetary side of things looks like for a while. So I think the message that Powell gave today, as jarring as it sounded, because he really was intentionally, it seems, wanting to put the market on notice that they're serious about countering inflation, however they might. It's what the market's been contending with for 3 weeks. It explains what the market's been doing for 3 weeks, as opposed to, all of a sudden at, 2:30 p.m., it blindsided us here. And that's why, the market's trying to struggle its way a little bit above the recent lows from Monday.
Agree. I don't think there were any big surprises there. Josh, if we close at these levels on the S&P, it will be 10% off the high, so technically a correction. NASDAQ's now about 16% or so off its highs. You've been looking at the history of drawdowns. What are you concluding about what we're going into here?
Well, I'm glad you're giving me an opportunity to talk about this, because this is what we are actually talking about with clients right now. And for the most part, it's us reaching out. It's not clients reaching out to us. I don't think it's been quite as volatile as it would take for people to really get nervous. But I think it's important to point out this year is not the aberration. Last year was. Last year, the S&P did 30%, and the max drawdown was 5.7%. That's bizarre. A lot of that is because of how active the Fed has been in these markets stimulating. What's going on now is entirely within the range of historical probabilities. The average drawdown over the last 94 years is 16.5% intra-year, which means half of them were worse. And if you look at those, typical drawdowns, in 59 of those cases, you're down in excess of 10%. In 24 of them, you're down more than 20%. So this could get worse and still be normal. And I don't think people have a grasp on this concept either, which is that just because you have a 16% drawdown an average or worse drawdown. 3 out of 5 instances, the market ends up closing higher, including, by the way, 1987. So we have to understand that stocks are not meant to only go down 5% in any given year. The problem we have is that 25 million new investors joined the stock market in the last 18 months, and they just haven't seen, other than March of 2020, normal volatility. So I think people just need to reorient themselves around the idea that bears are going to make money too every once in a while, and not every day is a sunny day. We're starting to get that message, it appears. And obviously it's going to be tougher for some areas of the stock market than others. But broadly speaking, this is what stocks should do. Last year is the strange year.